Welcome everyone again to another financial analysis video. You're here with me, Moeed Amin, and my colleague Ted Wainman. We have another gym company to look at. So we looked at one earlier, the gym group. We're looking at Pure Gym now. And the reason why is because they recently announced that they are considering another initial public offering. So they're thinking about going public again, and I'll go into a bit more detail about that in a second. Just to describe about Pure Gym and what they do, they have a model that is very simple, actually, in a lot of ways. So they have low-cost, flexible memberships, right? So their gyms are open for 24 hours. It's very low costs. I think something like £10 a month. It might have fluctuated since I last checked. And the good thing is that there are no contracts. So you're not stuck into a contract. It's very flexible terms. And Pure Gym are the owners of another group called, just checking my notes here, Fitness World Group. And they have operations in different countries in Europe, such as Denmark, Switzerland, and Poland. And the collective business makes them the second largest fitness operator in Europe. So this is a very interesting company to look at because they will be a great indicator into some of these recovery stocks or recovery businesses that have been affected by the pandemic, and looking at how they fared through that and how they could potentially come out of this with some strength. So before we go into the analysis, don't forget to like, share, subscribe. Love to hear your thoughts and comments. And also, if you have any requests on companies you would like us to analyze, do leave that request in the comments section below. So what we'll do is look at the financial analysis of this company. And as I say in a lot of our videos, this is just the financial analysis, right? So we're just looking at those fundamentals. If you are serious about either investing in a company like them or a similar business, or if you're thinking about doing business with them, we encourage you and recommend that you look at all the other aspects of this company in order to make an informed decision. One thing to note before we go into the analysis is, and look out for some information around this, in the first quarter of this year, which is 2021, it looked like their net debt was around £778 million, which is a large amount of money. Now, it won't show that figure in the financial analysis we look at today, but it's good for context. So you will start to see how that has increased or decreased from the financial statement we're going to be looking at. And we're also going to go into the structure of this business. So I wouldn't say it's a complex structure, but there is a lot in there that you need to look at in order to understand a bit more about this company. So we're going to dive into the structure of this business and how that actually helps with your analysis. So Ted, let's share with our viewers, what have we found about this company, and what are they indicating about the future for such companies as we come out of the pandemic and as we start to ease the lockdowns?
Well, good to see you, Moeed, and yes, welcome. Greetings from a very windy Cornwall, where it's been very hot over the last few days. So here we go. Here is Gym Limited annual financial report and financial statements. So if you look at Gym Limited's website, it says that Pure Gym is the name of the company, and you can find these on Companies House here in the UK very easily, and it gives you a little bit of sort of background about the company and what they're up to, etc., etc. And as you mentioned, it includes Fitness World and BaseFit. So it's actually part of a larger group. So what we really want to be doing is looking at the larger group rather than just Pure Gym. So if we do look at Pure Gym itself, we're just going to quickly touch on these numbers. Revenue, a massive hit to revenue, down 44%, and that is due to the pandemic. Next thing to note, cost of sales is effectively nothing because they don't sell anything. They rent out the space. And they do have lots of costs of running their gyms, and you'll notice those costs are pretty much fixed. So whether the revenue is high or low, they still pay the same rate. They have to pay the staff to come in to kind of look after it, to clean it, etc., etc., etc. And so this is really where the profit from 2019 turned into a loss in 2020. And then we notice a big financing cost. So this company is carrying a lot of debt, and it's carrying a lot of debt, and therefore it is it's, you know, the financing costs are high. And when the things are going well, that's not a problem because it can make a profit. But when things are going badly, it accentuates the loss and causes a few problems. So we're hoping that this is a bounce back play and that they're going to be back on track after the end of the pandemic. A few other things to note in their balance sheet. So property, plant and equipment. This is all the gym equipment that they've got, which they effectively lease. So there's a lot of lease liabilities sitting on their balance sheet. So the equipment is being leased, and that equipment, I mean, it's a high. So the equipment compared to the lease liabilities, there's our lease liabilities here and here. You know, that equipment that, you know, needs to be replaced fairly regularly. You know what it's like if you go into a gym and the machines are a little bit tired and a little bit old. You think, do I really want to come here? So we like kind of like brand new equipment in brand new spanking new gym. So there's a lot of ongoing investment required there. And finally, the debt. You know, a lot of the company is just funded through debt. You know, just to you know, as a primary source of funding. So the summary is the balance sheet is positive, which is good. There it is. It's down significantly on the previous year, and that's because they've made losses, and those losses have eaten into their retained earnings. No additional equity has been raised. However, there's no cash flow here, and there's no cash flow because it is, of course, a owned company. So if we go down to the last note, here we go. So the controlling party note here explains that it is actually owned by Pinnacle Topco Limited. Okay, so it's owned by Pinnacle Bidco, but Pinnacle Topco is the head of that pyramid, and that's really where we want to go and dig around and find out what's going on. So let's have a look at the Topco company accounts. So here we've got Topco accounts, and if we look at the first page, the business overview, this is the holding company for Pure Gym, as you mentioned, and which is the second largest gym fitness operator in Europe, as you also mentioned. And it also is operating in UK, Denmark, and Switzerland under Pure Gym, Fitness World, and Base Fit brands. So really what they're trying to do is to expand into Europe. And if you're interested in, and again, these accounts are available on Companies House, so very easy. All you need to do is to search for Pinnacle Topco, and they will pop up. So I'll leave our readers, our viewers, to read through the strategy and what the business is up to, etc., etc., in their own time. We are doing the financial analysis, so we want to jump all the way down and find the income statement. So here is the income statement, and we see the revenue. Now, interestingly enough, you'll notice that revenue has increased. Now, that kind of doesn't make sense until we find out why the revenue has increased. So while the pandemic has hit, this company has taken an opportunity to expand and to grow its business. So what it's been doing is it's been growing its business by buying other gym companies, and therefore the revenue has gone up. You'll notice again, cost of sales very, very small, because as a gym, they don't sell anything. There's probably, I don't know, water or something, or hot towels, but you know, really it's the costs of running the gym. And you'll notice here that the costs have significantly increased, and the reason for that increase is that they have bought another gym and they've taken on all the cost of that gym. So what we see is that they've moved from an operating profit to a loss, and that is pandemic related. And obviously the play is it going to come back to a a profit and an increased profit, because we'd expect the revenue to dramatically increase as people return to gyms at the end of lockdown. Interesting what you said about the debt, because look at the finance costs. Okay, so the finance costs have gone from 182 million pounds to 150 million pounds. That's the finance costs, 150 million pounds a year. That's quite a lot of interest to be paying. Now, there's a few funny numbers in there. We might want to have a look at that, and we can sort of look at note 10. And what you'll find is that some of that relates to the issue of debt, rather than just the interest on that debt. But it's, you know, it's a phenomenal number. It's a big number. And anyway, so the bottom line is that, you know, they are making a loss. They were making a loss in the previous year due to those finance costs. So that's the kind of, you know, that's the key thing that's causing the loss. And they're also making a big loss in this year due to those finance costs. And the story will be that as the pandemic comes back, revenue is going to ramp up. The costs, these are fixed costs, so they will stay the same. Therefore, we're going to become very profitable, easily able to pay the interest, and we're going to see a nice juicy bottom line. Okay. What's interesting here is, and if you have watched some of my other videos, I've talked about it. This is what's called operational gearing and financial gearing. A high operational gearing model is a high fixed cost model, and that's what these guys are. Lots and lots of fixed costs, which means that they are a high operational gearing, and they've also got lots of debt, which means they are high financial gearing as well. Both models are high risk, high return. So when you add them together, you've got very high risk, very high return. Here's the balance sheet. So we noticed the balance sheet, the assets have gone up to 1.6 billion, up from £1 billion. And you know, that's really due to the increase here will be the goodwill on acquisition, and obviously they have bought the property, plant and equipment of those new companies. So you know, they are buying machinery, but they're also buying companies that have machinery. Cash looking reasonably healthy at 91 million pounds, up from 51 million, suggesting that they've been doing some fundraising during the year. In terms of their assets, again, we've got, just as we saw with Pure Gym, there's quite a lot of lease liabilities. So what these companies are now doing, this is an international financial reporting standard request, is that they now hold, you know, if you lease a machine, and a lot of their machinery, most of their machinery will be leased. If they lease it, they hold the asset on the balance sheet as an asset, and the lease liability on the balance sheet as a liability. So we're not too worried about that. But what we do see is the borrowings down here. So the borrowings have increased dramatically from 760 million to nearly 1.3 billion pounds. So they have borrowings, debt of 1.3 billion. Now, you mentioned the figure of net debt, and that net means net of cash, and the cash is about 91 million pounds. So there's still over £1 billion on net debt on the face of this balance sheet. So if they've managed, so if we really are talking about the Topco company, and they've managed to get that debt down, then it looks to me like they're going to either generate a lot of cash somehow, or they may have done a debt for equity swap. So I'm not familiar with the numbers that you were talking about there, Moeed, but certainly, you know, the number I'm looking at is a company which has a lot of debt. And as a result of a lot of debt, all of this debt means that the balance sheet is negative. So there is the negative asset. So if you theoretically, if you close the company down, you sell all the assets, you won't be able to pay off the liabilities. They are technically insolvent, not actually insolvent, just technically insolvent. So here's the bottom half of the balance sheet. Here's the share capital and share premium. Not a lot of movement going on there. And we can see that the accumulated losses, you know, even at the beginning of the year for 2019, they were sitting on 130 million of accumulated losses. And because of the pandemic, it's gone up to 328. But they are being punchy, and they are out there, and they are buying additional companies. So those are kind of the big stories coming through the balance sheet. Let's go and have a look at the cash flow statement. So the first thing we notice for the cash flow statement is that these guys, as a fundamental, they are generating cash. Okay, and so this is a note 23 tells us about this. The cash generation is down, but they are generating cash as a fundamental. However, because of the bank interest that they're paying, because of the secured notes interest, because of the interest on their lease liabilities and the issue costs. So this is an interesting one. This is the cost from borrowing. So this is actually the cost to them of actually, paying the banks to kind of help them raise the money. They've actually made a cash loss. So this cash loss is really down to financing rather than operating. Fundamentally, they are operating and generating cash. Previous year, they were still generating cash, even though they were paying out all of this interest. In terms of what they're doing with that cash, so here we see this is the big purchase of the undertaking. So this is their kind of the expansion, the growth of the business, and then they are also buying property, plant, and equipment, and they have to do that because as I mentioned, they need new equipment, they need new stuff coming on board. If they don't, they end up with old, tired gym stuff, and then people say, "I'm not going," and they go somewhere else. And so down the bottom, the financing, quite interesting here. There's a kind of a few things that we have to kind of match off against each other. So if we could take these two numbers, there's the drawdown of a revolving credit facility and a repayment. So that's a kind of during the year, they borrowed 135 million, but they gave it back again. They have repaid bank borrowings of 117 million. You'll notice there's the repayment of a bridging loan. So they issued senior loan notes in order to repay a bridging loan. A bridging loan is just a kind of a temporary stopgap loan. And they've also got the issuance of preference shares and the repayment of a bridging loan. So in effect, the drawdown of a bridging loan. So the drawdown of the bridging loan and the repayment of the bridging loan, effectively what they've done is they take a bridging loan and then they've ended up with these senior secured notes, which are very, very senior debt. It's secured on the assets of the company, which means that if the company folds, these people are very, very first in line to get repaid, which means that with a negative balance sheet, you as a shareholder are very likely to get zero. So if they go bust, you're going to get pretty much nothing. In fact, you're almost definitely going to get nothing. So what do we see? The net effect of this is that they've increased their preference shares. So they've increased their equity by 100 million. They've increased their debt by 380 million. And they have used that in order to, basically to buy this new business effectively, and also to tie themselves over. So very much a kind of, a debt funded business model going on here. There's no listing, so there's no valuation to talk about from a share from a share value point of view. So that's really, those are the numbers, Moeed.
Yeah, interesting numbers to look at, right? So a lot of debt, the interest of payments of which have affected their cash flow. So definitely worth looking at more closely if you're interested in those kind of recovery stocks, right? So this will help you kind of analyze some of these other businesses. Now, there is a video that we recommend that you look at right after this one, which is another gym company that we analyzed, which is the Gym Group. Now, they are a publicly traded business, so you will be able to see the information on the public market, and you can do some compare and contrast on how that business is running versus the other. So do have a look at that company. And if you have any requests of businesses that you would like us to look at, about 98 to 99% of the companies we look at are actually requests from you, the viewers. Then do leave your request in the comments section below. And as always, like, share, subscribe. Ted, this was a very interesting company to look at based upon what's going on with the pandemic. So thank you for that. And until the next video, everyone, see you soon.
Absolutely, no worries, Moeed. I'll just leave you with a final thought that, you know, this is fundamentally it's a good company, but, you know, there's a tendency for private equity to load these types of companies up with a lot of debt and then float them with that debt. And we see this in things like companies like the AA, we see it in Saga. So if they do float, if they do an IPO, if you are interested in buying them, make sure you know what you're buying. Make sure you know how much debt you're buying, as well as the story and the equity and the great business success.
Yeah, and that's why we're doing these videos, right? So they did try to go public in 2016, but they pulled back because of uncertainties in the Brexit vote. So yeah, absolutely, totally agree. That's why we're doing these videos. So do your homework to make sure that you put everything you need to in terms of research and your investment thesis. So great point there, Ted. Thank you for sharing that. So until the next video, see you later, everyone.